इस पागल इंसान था, लेडी नहीं थी। पहले अपने को क्या बोला, लेडी है।
Hi everyone, very good evening. Hello, good evening.
Good evening, sir.
Good evening, good evening. How are you all? How's your studies? Can you hear me? How's the studies going on? All right. So, very welcome to the session of AAA. So, well, this is a doubt clearing phase, and we will be discussing with all your doubts and concerns during this session. And in addition to that, we will also be going through all the topics of the paper, AAA. And in addition to which, we will also be practicing some set of questions from the area of AAA. And this session will be purely exam oriented. And we will be doing a set of questions that have already been appeared in the past questions. And in addition to that, basically, we will also be discussing some of the technical articles as well. All right. So let's start directly with the session. And so basically, talking about the paper AAA. Well, you know that AAA is a paper which is having some set of defined questions. Basically, in the area of 50 marks as well as the first 25 marks question will be definitely be asked in the prior question papers. The same questions will be repeated. The only difference will be the changes in the scenario. And we will be having 50, 25, and 25 marks as a division for the paper. So which means that we will be having 150 mark question and 225 marks question. And we will be having 225 marks question, which will be from a defined area. Another 50 marks question will also be definitely from a defined area. So talking about the 50 marks question, the first 50 marks question will be definitely from the area of risk. So let's do one thing. Let's start with the 50 marks area. So the first 50 marks will be having some set of questions. The first one will be audit risk, or it can be business risk, or it can also be risk of material misstatement. And the question will range from approximately between 18 marks to maybe 23 marks. And there can also be chances that the question might have an additional part for additional information as well. So anyway, there will be a risk part, and out of the risk part, either it will be from the audit risk area, or it can be from the business risk area, or it can be from the risk of material misstatements as well. And in addition to this, we will be having next question, which is additional information, which is almost equivalent to the response part in the paper AA. But this is not pure response. Here we will be requesting the management or our audit seniors to provide it with some more additional information to understand more about the audit risk. So we will have a discussion about that as well. And there will be another question which will be based on audit procedures. And in addition to which, definitely we will be having questions on ethics as well. So this is how the 50 marks question will be like. The first question will be on audit risk. Then there will be a question on business risk as well as on the risk of material misstatement. However, it can also be appear as a combination question. It may be a question with a mix of business risk and risk of material misstatement. And this risk of material misstatements question will also have an additional part called analytical procedures, which means you need to calculate certain ratios. And in addition to that, you must also compare current year data with that of the previous year, as well as you need to compare the scenario with that of the financial statements provided to you. And basically by comparing that, you will be able to find out certain risk. That is something called analytical procedure. So you'll be getting a combination of risk of material misstatement from analytical procedures also in some cases. And I will also let you know about the marking scheme. So basically this part, as I've already mentioned, it may range from maybe 18 marks to 23 marks. Then the additional information question usually appears for 5 to 6 marks. Then the audit procedures are usually asked for 10 marks. And the ethics part are also usually asked for up to 10 marks. And another 4 marks from this area will be professional marks. So this is how the mark is split in the 50 marks area. So same as that of the way in which the questions was asked in the paper AA. We know that in the paper AA, basically we are having questions from 3 main areas. These are the areas of substantive procedures, then the audit risk, and that third part, control deficiencies and recommendations. Same as that, the 50 marks area is also pakka defined. Anyway, you will be getting questions only from this area. And in addition to this, we have got two 25 marks area, out of which the first 25 marks areas question is also defined. Definitely, it will be a question on reporting part. It will be a reporting question. So reporting questions are of many different types. We will be having a discussion about that on the upcoming days. And basically talking about an overall idea. The reporting questions might be in a way by which you will be getting a scenario. And on the basis of the scenario, the examiner will ask you to provide the auditor's opinion and the impact that will create over the auditor's report. And the questions will be from many areas, such as matters to be considered further action, matters to be considered discussion with the management, matters to be considered and audit evidence, matters to be considered and further procedures that need to be performed by the auditor. And all these are reporting questions. So we will be having discussion about that. And in addition to which, there is something called critical appraisal. There is something called critical appraisal. The critical appraisal means that you will be getting a pre-drafted report. It can either be an audit report or it can also be a report about the PFI, prospective financial informations. It can also be a report about the company's assurance engagements. It can be any sort of reports like that. And you will be asked to criticize that on the basis of the given scenario. Sometimes the auditor might have provided an inappropriate opinion. The format used might not be correct. They might have used some of the unprofessional wordings. Then they might not have properly mentioned about the standard names and standard numbers. And we need to figure out all those issues within the report and we need to criticize on that. So this is the two kind of questions that are basically asked in the reporting part, which is part of 25 marks question. And there will be another one more 25 mark question, and it can be from anywhere over the syllabus. The examiner have mentioned like that. It can also be from anywhere over the syllabus. But even though the examiner is mentioning that it will come from anywhere, still there are some defined areas. It may be a question on the due diligence. It can be a question again on the ethics part. It can be a question on the quality control. It may be a question on the KPI, so the key performance indicators, procedures, and it can be basically be like that. So we will have a discussion on that part as well. So this is a basic structure of the paper AAA. So 3 questions, 150 mark and 225 mark. The first 50 marks question will be a risk-based question. Second question will be a reporting-based question. And third question will be a mix of the total syllabus. So this is how the total paper is structured like. And out of which, today we are going to focus on the 50 marks area. And we will only be discussing the things relating to 50 marks. And we will also be taking some time from tomorrow to discuss the remaining part of the 50 marks area as well, because mostly we won't be having adequate time to discuss the areas of business risk today. So we'll be focusing more on the audit risk and risk of material misstatements today. And tomorrow we will start with the business risk part. And tomorrow we will also start with the part B, maybe the reporting part. And day after tomorrow also we will be focusing on the 25 marks area. So this is how we are planning our session. All right. So as I've already mentioned, we will start with the 50 marks area, the risk part. And first of all, let's start with the area of audit risk. So let me ask you, what do you mean by audit risk? Can you please unmute and respond over the mic? What do you mean by audit risk?
It's a risk that auditor expresses an inappropriate audit opinion.
Exactly. It is a risk that the auditor might express an inappropriate audit opinion when the financial statements are materially misstated, right? So say, for example, consider like this. There was a mistake in the financial statements and the auditor is stating that the financial statements appears correct. There are no mistakes in the financial statements. Suppose the auditor have selected 20 transactions as sample out of total 100 transactions. And unfortunately, in this 20 transactions, there were no mistakes. And the auditor is giving his opinion that the financial statements are true and fair. There are no mistakes within the financial statements. And he have given a conclusion like that. However, in case if there are mistakes in the rest of the remaining 80 transactions, he will not be able to detect that. And this possibility is known as audit risk, giving an inappropriate opinion on the financial statements. And we know that basically the audit risk arises due to 3 different issues. Which are the 3 components of the audit risk?
Inherent risk, control risk, and detection risk.
Exactly. There will be inherent risk. There will also be chances of having control risk, and there is also a possibility of having detection risk. So these are the three possibilities of having risk as part of the audit risk. So what do you mean by inherent risk? What do you mean by inherent risk? Any idea? What do you mean by inherent risk?
It is due to the inherent nature of the business.
Exactly. Inherent risk is a risk which is based on the nature of the business. Say, for example, if our company is involved in gold manufacturing, we know that gold is a product whose price will always keep on varying. So it is very necessary for an entity to record the gold's value at lower of cost or NRV at all times as possible. And if the company is not measuring it at the right time, there can be chances that the inventory value will be overstated. In addition to that, consider like this. Suppose if a company is involved in complex set of transactions, like say, for example, if a company is having more than 25 subsidiaries, it is quoted in the question that a company is having more than 25 subsidiaries. In that situation, we know that the consolidation process will be very difficult and the possibilities of having mistakes in consolidation will be very high. Again, that's a cause of inherent risk. There can be chances that the company might have been involved in many of the foreign currency transactions. And in case if a company is involved in foreign currency transactions, the amount of retranslation should be made with correct exchange rates. And if not, there can be chances that the expenses and the income, as well as the assets and liabilities, might be under or overstated if the company is using inappropriate exchange rates. Again, there can be chances that if a company is dealing with a lot of maybe financial instruments, or the company might be having many type of performance obligation in relation to the revenue, then there can be chances that there is a complex treatment with the IFRS 15, or there can be chances with mistakes in the IFRS 9. So again, there is some set of risk. So these are the nature of the risk that arises due to the nature of the activities that the business are involved in. So this is something called inherent risk. Okay. And when it comes to the control risk, basically, we know that every company will be having some set of internal controls. However, consider like this. Suppose if a company's internal control system is not operating effectively, and if the internal control system is not operating effectively, the possibilities of having mistakes in the financial statements will also be very high. And say, for example, if a company's internal control system was not operating effectively, and in that situation, if a particular mistakes appear, then that internal control system will not be able to prevent, detect, and correct the mistakes in the financial statements. And thereby the financial statements will be materially misstated. And that possibility is known as control risk. Control risk means that if the company's internal controls are not operating properly, there is a possibility of having mistake in the financial statements that will not be prevented, detected, and corrected. That is something called control risk. Is it clear, guys? Okay. Then the third phase of the risk is the detection risk. And basically talking about the detection risk, this is the one and only risk that arises from the part of the auditor. The auditor is enabled to find the mistakes in the financial statements by performing the set of audit procedures. And if the audit procedures performed by the auditor does not reveal the mistakes appeared in the financial statements, it is a possibility of having detection risk. So these are the three risks that arises while an auditor performs an audit. So inherent risk, control risk, and detection risk. Out of which the one and only risk that arises from the part of the auditor is the detection risk, and the other two risks are the inherent risk and control risk. And we must always understand a great fact that we cannot control the inherent risk and control risk in any manner, because both of these have already been part of the company's financial statements preparation. So we cannot do anything with that. The only thing that an auditor can manage is the amount of detection risk. And therefore, we will call this inherent risk and control risk together as the risk of material misstatements. We will call the inherent risk and control risk as risk of material misstatement. And therefore, this risk of material misstatements cannot be controlled by an auditor. And the only risk that an auditor can control will be the detection risk. And we can call that audit risk is a combination of risk of material misstatements and detection risk. And in case an auditor needs to reduce the overall audit risk, the only way in which he can reduce the overall audit risk will be by reducing the amount of detection risk. And if the auditor needs to reduce the audit risk, what do you need to do? You need to reduce the detection risk. And how can an auditor reduce the amount of detection risk? Over to you. How can an auditor reduce the amount of detection risk? It's a risk that arises from the part of the auditor that he is not able to find the mistakes in the financial statements. And how can he ensure that he will find out the mistakes in financial statements?
Using experienced members in the team.
Exactly. He need to perform more of the audit procedures, right? He need to increase the amount of audit procedures. By increasing more amount of audit procedures and by obtaining sufficient appropriate evidences, he will be able to reduce the amount of detection risk. So this is a basic structure of the audit risk. So I will repeat again, audit risk is a combination of basically three risks, which are the inherent risk, control risk, and detection risk. And the inherent risk and control risk can together be called as a risk of material misstatement. And the detection risk is the only risk that can be managed by the auditor. And in order to reduce the amount of detection risk, the auditor needs to increase the amount of audit procedures that are being performed by him. All right. Then you will be getting either a question on the audit risk part, as I've already mentioned, or you will be getting a question on the risk of material misstatement. So the first thing that you need to keep in mind while doing a 50 marks question is to identify whether you have got a question on the audit risk or on the risk of material misstatement. And the difference that make in your answer is the fact that in case if you're getting a question on risk of material misstatement, you're not required to mention anything relating to the detection risk. And you should mention about the detection risk only if you're getting a question on audit risk. So you should read your requirement carefully and ensure whether it's a question on the audit risk or risk of material misstatement. And if you're getting a question on risk of material misstatement, you should avoid using detection risk within it because it will unnecessarily kill your time and you won't be able to score anything for writing that part of detection risk area. Okay. So this is the basic audit risk structure. So I hope you might have got an overall idea about the audit risk theoretical area, but this part won't be tested in your exam as part of your, same as that of your AA exams. And you will be having only indirect questions from this area, which are the scenario-based questions. And for appearing those scenario-based questions, you need to consider certain facts. See, there are some reporting formats for each of the types of question that will appear for the exam. Some exam formats are already being structured by the examiner, but at the same time, we have also structured some of the points as well. So if you're getting a question on audit risk or risk of material misstatement, the answering format should include the calculation of materiality. You must calculate the materiality first. Then next, you need to talk about the accounting treatment for each of the question. You need to talk about the accounting treatment. In addition to that, you must mention about the possibilities of having errors. Just a moment. Yeah. So yeah. In addition, you need to talk about the risk of mistakes, the risk of misstatements, and about their impact on FS. This is how you need to present the answers of audit risk and risk of material misstatements. So first of all, about the materiality. So while calculating the materiality, you must calculate the materiality both on the basis of SOFP elements, which are the account balance items, as well as you need to calculate the materiality on the basis of the SOPL elements, as well as you need to calculate the materiality on the basis of its nature. So first of all, in case if you are getting a particular figure, if it is mentioned in the question that a company has received 15,000 as revenue, and the company has kept it as a deferred income. It's mentioned like that. And in that situation, you need to calculate whether that 15,000 is material or not. And for that purpose, you can calculate the materiality on the basis of SOFP figures. So for example, you will be able to calculate the materiality on the basis of the entity's total asset. And what is the materiality benchmark of the total asset? So what's the materiality benchmark for total assets?
1%.
Yeah, it's 1% of the total asset. Then what about net assets? Net assets?
2%.
2% of the net assets. Then when it comes to the SOPL, so what's the level of materiality for the revenue?
0.5%.
Yeah, it's 0.5% or half percentage. Then what about the materiality for the amount of gross profit?
0.5%.
Again, half percentage, right? Yeah. And in addition to that, we will also be calculating materiality on the basis of profit. What is the amount of materiality for the profit? 5%, right? Yeah, we will take the lower limit. It's a 5%. So you must consider materiality either on the basis of any of these two elements. Okay. And if any of the amount appears to be material, at least in any one manner, then you can treat it as a material figure. However, there can also be chances that the amount might not be material on the basis of its value, but it can still be material on the basis of its nature. Say, for example, if the question is mentioning about a related party transaction, basically this is the one set of materiality will be appearing in your question on the basis of nature, related party transactions. And the related party transactions may be the transaction between the parent company, then subsidiary company, then what else? Maybe it may be a transaction with the companies.
Key management person.
Yeah, key management persons. And it can also be some set of transaction which is directly be mentioned with the directors and so on. So you must consider whether there is any possibility of having some set of transaction with the related parties. Then if there is any possibilities of having related party transactions, definitely let it be any small amount, still it will be material on the basis of its nature of the transaction. So this is how we will calculate the amount of materiality. So first of all, the thing that you need to do is to calculate the amount of materiality. The next thing is that you need to consider about the accounting treatments. Suppose consider like this, you're getting a scenario and it is mentioned in the scenario like this. A company has received 10 million from its customers for making a bespoke product. And the company is about to start the production by the end of this month. It's mentioned like that. So just tell me what should be the accounting treatment in that situation, which is the accounting standard that comes there. The company have received 10 million for creating or manufacturing a bespoke inventory, and the company is planning to start the production by the end of this month. So what should be the accounting treatment in that case? What should be the accounting treatment? Which is a standard that we need to use there? It's IFRS 15. Perfect. Then, Faisal, then how can we include that amount within the financial statement? Do we need to recognize it as a revenue or as a deferred income?
So we can recognize as revenue once we get satisfied the performance obligation.
Okay. We will be able to recognize it as a revenue only once the performance obligation is being satisfied. Until that date, how do we need to recognize that?
Deferred.
Yeah, we need to keep that amount as a deferred income. And this is the accounting treatment that we need to mention there. And what can be the risk of mistake there? Is there any possibility of having mistake?
Overstatement of revenue and understatement
Overstatement
of
of
deferred
revenue
income.
and understatement.
Exactly. The first thing that you need to mention is about the risk. Okay, after that, we will mention about the impact. So first of all, you need to claim that there's a possibility that the company might be recognizing the amount as a revenue rather than treating it as a deferred income. And what happens in that case? It may lead to overstatement of revenue and understatement of the deferred income. So this is the total structure of the answer. So I will prop it again, consider like this. Consider that amount as material. So first of all, you have to give a heading called revenue or anything as you wish. Heading doesn't count anymore, but still for the presentation purpose, we'll be giving a heading. So we'll be giving a heading like this, revenue. And after that, you mentioned about the materiality. The amount of revenue of 10 million received from the customers amounts to 13% of profit and 5% of the total asset. Therefore, it is a material amount. As per IFRS 15, revenue from contracts with customers, revenue should be recognized only when the performance obligations are being satisfied. Until the day, revenue should be recognized as part of the deferred income. Next, mention about the risk. However, there can be chances that the company might have recognized the total amount of 10 million as part of the revenue impact. And there can be chances that it may lead to overstatement of the company's revenue and understatement of the related expenses. Is it clear, guys?
Yes.
Okay. So this is how we need to present the answers about the audit risk. And say if you're getting a question on the risk of material misstatements also, you will be following the same format. There's no difference at all. The only thing that you need to consider is you should not mention anything relating to detection risk. All other things will remain the same. Especially if there is any mistakes in relation to accounting treatment, it will be common in both the audit risk part as well as the area of risk of material misstatements. Perfect. Then let us discuss about one more example, very simple example. Consider like this. The question is mentioning that the company have spent 30 million for research and development. So what is the possibility if a company spends 30 million for research and development? What should be the accounting treatment adopted there?
Yes.
IS 38.
Yeah, perfect. IS 38. And how do we need to treat it as per IS 38?
There is a risk that research expenditure would be incorrectly classified as development expenditure.
No. Let's talk about the accounting treatment first. So what should be the accounting treatment there?
Research cost should be expense and development cost should be capitalized.
Exactly. All the research expenses should be expense in the P&L, and the development expenditure should be categorized as an intangible asset only if the criteria is being met, right? And what is the risk there?
Even though internally generated intangible assets only we can capitalize, right?
Sorry?
Internally generated intangible assets, that one only we can capitalize, right? Internally generated.
We cannot capitalize the internally generated intangibles such as the brand name and goodwill and other things. In case if we are developing a new product, then we will be able to include it as part of the intangible asset. And in case if we are buying a particular company's brand name, or if we are getting a goodwill at the time of acquisition of another company, then we will be able to include it as part of the intangible assets. In other situation, we won't be able to include the internally generated goodwill and brand names as part of the intangibles. Okay. All right.
Okay.
So while, we were discussing about the answer, right? So what will be the risk of mistake there? There can be chances that the company might have included some of the research expenses as part of the development expenditures. What will happen in such situation? What will
the company
be the
can incorrectly recognize the revenue expenditure as capitalized.
Okay, then what will be the impact on first? The amount of intangibles will be overstated and related expenses will be understated, right? Perfect. Okay. So this is how again we need to present the answer. So we'll be quoting like this. The company have spent 30 million for research and development expenditure. And out of the 30 million spent on research and development expenditure, the amount amounts to 5% of the total asset and 13% of the revenue. Therefore, it is material. Then next, you talk about the accounting treatment. As per IS 38 intangible asset, all the research expenses should be debited in the P&L and the development expenditure should be capitalized only it is being met the development criteria. And you must also mention about the criteria in a very short style. And you mentioned that the risk, there is a possibility that the company might have included some of the research expenses as part of the development expenditure, leading to overstatement of intangible asset and understatement of related expenses. This is a reporting format. Is it clear, guys?
So when we are writing accounting treatment for intangible assets, can we write pi rates? The pi rate?
Well, there are no such condition as part of pi rate. That is just a mnemonic that we have learned for our understanding. So you need to give a very short span about the criteria. Well, it's not required to expand the criteria to that extent. You need to mention about the criteria in a very short style. You can write it in your own words. Okay.
So the technical feasibility, like the main thing, the correlate, the only.
Yeah, the core thing that is relating to the question should already be included there.
Okay. Okay, sir.
So this is the first category of the question, or the first category of risk that can appear in your 50-mark area as part of the audit risk and risk of material misstatement. And there is also another style of asking the audit risk. And in such situation, you need to present the answers in other style as well. So there will be some questions that does not contain the accounting treatment. They will only be asking you to mention about the risk in relation to some of the general situations. In that situation, first thing that you need to do is the fact that you need to identify the risk. Then you need to explain the risk. And you need to mention about the overall impact as well. Overall impact on financial statements. Say, for example, it may be mentioned in the question that the company has appointed a new finance director. And it will be mentioned like this: the finance director is having more than 10 years of experience in banking sector. And at the very beginning part of the question, it will be mentioned that the company is involved in pharmaceutical business. So what will be the risk there? The company is involved in pharmaceutical and he is coming from bank. So what will be the risk?
Lack of experience.
Lack of experience. Okay. Then if there is lack of experience, what will happen? The finance director, what will happen in that case?
Financial statements would be misstated.
Materially misstated.
Yeah, financial statements will be materially misstated. That is the overall impact, right? So you need to explain about the possibility of risk. So he's not having adequate amount of experience. So what will happen then?
Detection risk will be high for us.
Risk is high.
Yeah. And there can also be chances that he might be taking some of the inappropriate accounting treatments and estimate, right? Okay. So that's a risk here. So we need to mention like this. First of all, you need to identify that. Just mention the same line that is being mentioned in the question. So you will be mentioning like this: the company has appointed a new finance director who is having experience in the banking sector, but the company is having its operations in pharmaceutical business. Then explain that. Therefore, there can be chances that the finance director might lack adequate amount of experience. And in that case, the accounting policies and the estimates adopted by the finance director might not be appropriate, leading to overall material mistakes in the financial statements. And the possibilities of having financial statements materially misstated will be very significant. This is the risk. Clear?
Yes.
Okay. Consider like this. It will be mentioned like that. Suppose if a company is having some of its inventories that are being held in a foreign warehouse. So what will happen if a company's inventories are being held in foreign warehouses? What will happen if a company's inventory are held in foreign warehouse? What will happen in that case?
Stockouts.
Transportation issue.
Transportation issue for whom? For the auditor or for the management?
It's a retranslation risk.
Okay, retranslation risk. Okay, you can mention about that. Oh, consider like this: the company is
Is
having
that
its
third
operations
parties
in.
or our own?
Just a moment. I will amend the case statement. Company is having its business in Bangalore, and one of its warehouse is in Delhi. So what will be the risk there?
Inventory count procedures would be difficult.
Yeah, inventory count procedures for the auditor will be difficult because the auditor will not be able to appear for the inventory count. And what will be the risk in that case? Is it an inherent risk, control risk, or detection risk?
Detection risk.
It will be a detection risk, right? So if it is mentioned in the question that some of the companies' inventory are being held in some other third-party locations or some other faraway locations, then we can state that there is always a possibility of having detection risk, as the auditor will not be able to attend for the inventory count procedures. And in that case, the auditor will not be able to understand about the existence and condition of the inventory. Therefore, they will be having high amount of significant chances of having detection risk. So that is a risk that appears there. Clear, guys? Okay. Let me ask you, suppose if it is mentioned in the question that the company is a newly listed kind, or if it is mentioned that company is planning to have a listing in a foreign stock market in the near future, what will be the risk there?
Management bias.
Lack of knowledge of listing requirements.
Lack of knowledge about the listing requirements. Perfect. So what will happen if they are not
management
having
bias?
knowledge of
They
listing
will
requirements?
incorrectly state the profits
Okay.
and revenues. They will increase the revenues in the financial statements.
The first risk that we were discussing is about the lack of knowledge about the listing requirements. So we can state that if the management is not having adequate amount of knowledge about the listing requirements, there is always a possibility of having mistakes in the financial statements, that they might not have provided adequate amount of disclosures in relation to listing requirements, and the financial statements disclosures will be materially misstated. And Sriman, what was the other point you were talking about?
The management bias.
Yeah, the management
Management will intentionally increase the revenues and the profits in the financial statements to give the good picture of the company to their shareholders.
Exactly. Correct point. So the management might be biased. They might be willing to overstate the amount of profit, and they might be willing to overstate the amount of total assets, and will be reducing the amount of liabilities in order to attract the potential investors and to get a good picture in the stock market. So there is a possibility that the financial statements will be materially misstated. So this is the risk that appears there. And these are the kind of general risk. And this general risk won't be having any set of accounting treatment. So the only thing that you mentioned there is that you need to identify the risk. Then you need to explain why there is a risk. And you also need to explain about the overall impact that will be created by the risk on the financial statements. Okay. And I will share you a file by the end of this session, or you can also download it. Just a moment. Yeah, I will be sharing you some set of files, or you will be able to download it from the Eximus website. So the first file that we will be using will be a file on the audit risk. Okay. And well, this audit risk file is a summary statement which includes multiple risk scenario. This file is all around 17 pages, and I've included almost all usual risks that used to appear in your exam. Okay, so these are the set of risks that usually used to be there in your exam. So say, for example, this contains all the general risk as well as the specific risk on the basis of the scenarios. So if it is mentioned in the question that the company is a newly listed client, we can state that if the company is newly listed, what will happen? The possibilities of having management bias will be very high. And you can also include that the lack of knowledge about the listing requirements, in that case, the financial statements disclosures will be materially misstated. It may be mentioned in the initial part of the question that the company is a new client. So what will be the risk in case if a company is a new audit client? Definitely there is a possibility that the opening balances may be materially misstated if it is a new client. And we might not be having adequate amount of knowledge. As an auditor, we might not be having adequate knowledge about the opening balances. And in that case, the opening balances might be materially misstated. Then there can also be chances that since it's a new client, the auditor might not be familiar with the client's accounting policies, transactions, and balances, and which may in turn lead to the amount of deduction risk. Then, if it is mentioned in the question that the company has appointed some new finance director, or if it is mentioned that the company lacks a finance director, in both cases, the risk is almost similar. If the company has appointed a finance director who lacks experience, automatically the possibility of having mistakes in the financial statements is very high. At the same time, if the company lacks a particular person who must have adequate amount of knowledge in financial reporting, if that such a particular person is not there, definitely again the possibility of mistakes will be high because there won't be anyone to check whether the financial statements are misstated or not. So this is a basic risk that arises here. So this is how the notes are structured. I have listed all the basic cases that used to appear in your question. So if there is weak corporate governance, what will happen if the weak corporate governance is there? The board of directors will be being overridden by the company's shareholders. And due to the pressure of the shareholders, automatically the board of directors will be biased. That's a risk there. Company has introduced a new IT system. What will happen in that case? There is a possibility that the company might be transferring some set of data from their existing operations to the new IT system. There can be chances that either the data might be omitted or the data can be also duplicated, leading to material mistakes in the financial statements. What happens if a company has got e-commerce transactions? What happens if the company is having inventory at multiple locations? What happens if there is a product recall? In case if the company is getting a bespoke inventory, then what happens in case if the company is recognizing revenue when the deposits are received? Then what happens if a company is recognizing revenue for the first time as per IFRS 15, or if a company is going for the adoption of a standard for the first time, depreciation of a component asset, revaluation of the property? What happens when a company is not recognizing the revaluation gain on the, deferred tax is not recognized on revaluation gain? What happens with the investment properties? Equity share capital is held for sale. Then, research and development cost recognition, amortization of the intangible asset. And these all are the related cases I have mentioned here. So please ensure that you have gone through this file, and this will definitely help you to have an overall understanding about the basic risks that are being asked in an exam. And I can assure you, basically the general scenarios will remain the same, and you will be able to expect the fact that the same kind of questions will be there for your exam. And the only thing that differ will be the area of accounting cases, which means that there will be new accounting treatment that are being asked for the exam other than that I have mentioned in these pages. So if you need to crack down any set of question, the only thing that you need to do is to have an overall understanding about this note. Plus, you must also have a proper understanding about all the SBR standards. SBR standards are very vital for your paper because literally the paper AAA is a combination of SBR and AA. There are only very few topics, additional topics in the paper AAA, and all other topics are pakka copy of the topics from your AA paper. So study the AA parts, which means I will be teaching you that parts. In addition to that, you must also focus on the SBR standards. Okay. So these are the common set of points that I've included as part of the audit risk. In addition to that, I have also taken a specific area for the group specific scenarios. You might also be getting questions on the audit risk of a parent entity. So you will be responsible for the audit of the subsidiaries as well as a parent, or you might be responsible for the group audit. And in that case, there will be a lot of intra-group transactions that will be mentioned in the question. Definitely, there is a possibility of having acquisition of a new subsidiary or disposal of an existing subsidiary, acquisition of an associate, or about the disposal of an associate. There is always a possibility of having questions from any of these four parts. And in that case, the only way in which you can crack that is to have a proper understanding about the group-based accounting treatments. And for that, what you need to have to do, first of all, you have to revise the areas from your SBR or from F7 paper. If anyone of you haven't done the SBR paper, please go through the F7. So you might be familiar with the working notes that we used to prepare while we calculate the consolidation part. So the working notes should be revised properly because you will be having questions on the goodwill. It might be mentioned in the question that the company have acquired a new subsidiary, and by the acquisition of the subsidiary, the company has recognized a revenue, goodwill of 20,000. It will be mentioned like that. And in that case, you need to consider about all the risks that might be there in relation to the goodwill acquisition. So you need to think about the calculation and the way in which you need to recognize the goodwill, and the opposite will be the risk. So just do one thing, please go through the consolidation part, and after that, you please go through the notes that I will share you today. An intra-group transaction, what will be the risk when there is an intra-group transaction? We know that in individual financial statements, the intra-group transaction will need to be accounted as per IAS 24 related party transactions, and the risk is that the company might not have provided adequate amount of disclosures. And when it comes to the consolidated financial statements, we know that all the intra-group transactions should be eliminated. And again, there is a risk that the inter-group transactions might not be eliminated by the company, leading to overstatement of both receivables and payables. So these are the common risks that we need to mention there. So please go through all these areas because it will definitely be helpful for you while doing the questions on group scenarios. And disposal of a subsidiary. So the questions might not provide you much information about the disposal of the subsidiary or not. It will be just mentioned like this. The company has acquired a new subsidiary this year, and at the same time, the company have disposed of one of the older subsidiary, on which the company were having 100% shares or shareholding. It will be mentioned like that. And in that case, what you need to do, you need to think about all the accounting treatment that will happen during the course of disposal of a subsidiary. If you are disposing of a wholly owned subsidiary, we know that all the assets, liabilities, and equity should be de-recognized. There is a risk that this might not be done. You know that the profit prior to the disposal should only be included within the company's financials. Any profit after the disposal should not be included. There is a risk that the company might have included. There's a risk of having errors in the calculation of profit on disposal of the subsidiary. And if the profit on disposal is not properly calculated, current year profit might be under or overstated. We know that in case if a subsidiary is being disposed of, we need to provide separate amount of disclosures for the disposal of subsidiary. There can be chances that they might not be providing that disclosures. It's a possibility of having mistakes. So these all are the mistakes that are associated with the disposal of a subsidiary, and definitely it won't be mentioned in your exam. And the only thing that you can do is to have an overall understanding about all the accounting treatment that you used to do using that during the time of your disposal of subsidiaries. And all those risks should be considered while incorporating your answers also. Then, In case if a company is having foreign subsidiaries, we know that at the year end, we need to retranslate the amount of assets, liabilities, and while the time of consolidation process, we need to retranslate all the income and expenditure at the spot rate. There is always a risk that the company might be using inappropriate spot rates and other year-end closing values, and due to which it may lead to material mistakes in the financial statements. And we know that, again, the year-end retranslation will result in either retranslation gain or loss, and the retranslation gain or loss should be taken to, is it to the P&L or to the OCI? To a OCI. And what will be the risk there? There can be chances that the company might have taken it to the P&L, leading to understatement or the overstatement of the profit. Then there is also a possibility of mentioning about an acquisition of an associate. And in the case of acquisition of associate, again, it will be just mentioned as a single line item in the question. It will be mentioned like this: the company have acquired a new associate during the year, over which we are having more than 30% of the shareholding. So this will be the only statement that is being provided in your question. And in that case also, what you need to consider, you need to consider all the accounting treatments. First of all, we know that in case if we are going for an acquisition of an associate, we need to treat it as the IAS 28 investment in associate and joint venture basis. And we will be considering the associate's payment in equity method, whereby we need to mention the investment in associate within the SOFP, as well as the profit from associate will be shown as a single line item in the face of the SOPL. And there can be chances that the company might not be familiar with this, leading to material misstatements in the financial statements. And we know that once the acquisition is done, in the subsequent years, we need to have a review for the impairment, and there can be chances that the company might not have done the impairment review, again leading to material mistakes in the financial statements. So these are the basic scenarios. Then it might be mentioned in the question about the acquisition of an associate. In that case, again, we can state that all the transactions from the associate should be disclosed in the financial statements. In addition to that, the addition should be mentioned in the P&L as a head item as per IAS 1 presentation of the financial statements. There can be chances that company might not have provided that. Plus, you can also talk about the associate's classification. You must always keep this point in mind. Even if it is mentioned in the question that the company went for an acquisition of a subsidiary or an associate, we know that just by having more than 20% of shareholding in associate and having more than 50% of shares in a subsidiary will not make it an associate or a subsidiary. Only if we are having a significant influence over another company, we will be able to call it as an associate. And only if we are having dominant influence over another company, we will be able to call it as a subsidiary. There can be chances that even if the company have acquired some of the shares in any of these companies, might not be making them either a subsidiary or associate. In that case, the total financial statements would be materially misstated. So we can also state that there is always a risk that the company might not be having significant influence even the acquisition has taken place. In such situation, the presentation and the classification of the financial statements should be completely amended, or else the financial statements will be materially misstated. So these all are the risks that arises as part of the company's audit risk or risk of material misstatements questions. And as I've already mentioned to you, anyway, you'll be getting a question. 100% sure you will be getting a question either on the audit risk area or the risk of material misstatements area. And if you're getting a question on the audit risk part, then always keep in mind, you must use this answering format for writing the answers. First of all, you need to mention about the materiality, then about the accounting treatment in detail, then the risk of material misstatements and the impact on financial statements. And if you're getting a general question on the risk part, first of all, you need to identify the risk, then you need to explain the risk, and you need to mention about the overall impact over the financial statements. So this is how you will be presenting your answer. Then another, the most important point. Once you have received a scenario from your examiner, you should never try to pick risk from the scenario, because you won't be able to find any risk from the scenario directly. You should not focus on finding out the risk in the scenario. Instead, you consider the accounting treatment. So say, for example, if it is mentioned in the question that the company have received 20,000 as a revenue for a bespoke inventory, you should not think about the risk there. First of all, you think about the accounting treatment. What should be the accounting treatment there? Yeah, if the revenue is received, then it must be kept as a deferred income. Then after that, you think about the risk. The risk will be the opposite of the accounting treatment. Yeah, it is required to be treated as part of the deferred income. However, there can be chances that they might have included as part of the company's revenue, leading to overstatement of revenue, understatement of deferred income. Consider like this and think like this. Then only you will be able to find out the real risk in the scenario properly. So you should never try to pick risk directly from the scenario, because you won't be able to pick. And at the same time, if you are able to pick, definitely it will be consuming a lot of your time. So basically, you need to focus on one thing, try to figure out, note the risk accounting treatment from the scenario, and the opposite of the accounting treatment will be the audit risk. That's it. Okay. So these are the basic things that we need to consider while writing the risk-based scenarios. Okay. So any one of you have got any doubts in relation to this? Any doubts? Is it clear, guys?
No, sir.
So what I actually mean, you have got any doubts or is it clear?
It's clear.
All right, all right.
So I give an example for the grant related accounting.
Sorry?
If they are asking the audit risk, grant, government grant.
Okay, grant.
Yeah.
All right, all right. So say for example, if it is mentioned in the question that the company have received 20,000 as grant during the current year for spending for the company's employees' expenditure for over the next 3 years. If it is mentioned like that, then we know the fact that the grant as per IAS 20 should be recognized again on what basis?
Sorry.
How can you recognize a grant? If you're getting a grant for over the 3-year period, can you recognize it within the current year period itself? No. What you need to do, you must be recognizing the amount of grant as an income during the current year only for the share of current year. The other 2 years income should be kept as part of the deferred amount, and that should not be recognized within the current year period. And the risk can be that the company might be recognizing the total amount of grant within the current year financials itself, leading to overstatement of the profit and understatement of the deferred amount. Clear?
Yeah, okay.
Okay. All right, guys. So these were the risks that are based on the accounting-based scenarios. And as I've already mentioned, you will be getting a question on audit risk plus analytical procedures. But this is very rare to get a question on the audit risk plus analytical procedures. But it's very common to have a question on risk of material misstatements plus analytical procedures. So if you're getting questions on this basis, that's a combination of risk of material misstatements plus analytical procedures. And the only thing that you need to do over there is to have a calculation of some set of ratios. And after calculating these ratios, you need to interpret these ratios. That is all you need to do here. So consider like this. The examiner will be asking you to calculate the ratios to perform the analytical procedures. And in that case, you need to calculate the ratio for both the current year. Suppose if the current year is 2016, and you need to calculate the ratio for 2015 as well as the previous year. And there are some common set of ratios that you need to include within some set of questions, such as the gross profit margin, then the operating profit margin. Okay, gross profit margin, operating profit margin, then the receivables days, then the payables days, the inventory days, then the current ratio, quick ratio, interest cover ratio, or the gearing. Any one is enough, interest cover ratio or gearing. So these are the basic ratios that you can calculate in every question. And once after calculating the ratios, you must also be interpreting these ratios as well. So consider like this. If a company's gross profit margin is 20% for the current year period, and if it was 18% for the previous year period, we know that there is an increase in the amount of gross profit margin. There's no issues with that. And next, the company's operating profit margin was 16% in the prior year and 18% in the current year. Again, there is no issues because the gross profit margin of the company has increased as compared with the prior year. Same as that, there is also corresponding increase in the amount of operating profit margin. We can call this movement as a direct movement. Both are moving in the same direction, both the gross profit margin and the operating profit margin. And there can also be chances that the gross profit margin of the company might be decreasing in nature, and the operating profit margin might also be decreasing in nature. Again, there is no issues because both are decreasing in nature, so they won't be having any issues of such risk. However, there's a possibility that the gross profit margin might be increasing as compared with the prior year. However, the operating profit margin might be decreasing in nature. The gross profit margin has increased from 18% to 20%, but the operating profit margin might be decreasing from 16% to 12%. In that case, we can consider a risk in this scenario. Only if there is an inverse movement. So basically, we know that in order to have an increase in the amount of gross profit margin, either there will be an increase in the revenue or there will be a reduction in the amount of cost of sales. And in order to decrease the amount of operating profit margin, again, there is only two possibilities. Either there is a possibility having reduction in the amount of revenue or increase in the amount of operating expenses. So we will avoid the common things here. So the revenue, because GP margin is increasing and the operating margin is decreasing. So we will avoid the revenue part because in order to have an increase in the amount of gross profit margin, the revenue should have been increased. The only thing that we are going to consider here is the cost of sales and operating expenses. The gross profit margin has increased and operating profit margin has decreased. So we will be assuming like this. If a company's gross profit margin is increasing, then the cost of sales might have been decreased and the operating profit margin has decreased. There is a possibility of having increase in the amount of operating expense. And we will quote the risk like this. There is a possibility that the company might have misclassified the amount of expenses that need to have been included within the cost of sales into operating expenses. And if the operating expenses are misclassified, it may lead to overstatement of the operating expenses and understatement of the cost of sales. Is it clear, guys? Okay, so if you're getting a scenario like this, that's stating the gross profit margin has increased and the operating profit margin is decreased, assume like this, there is a possibility of having misclassification of the amounts that need to have been included within the cost of sales to the operating expenses. In that case, the operating expenses will be overstated and the cost of sales will be understated, or vice versa. Say, for example, if you are getting a scenario that the operating profit margin is increased and gross profit is decreased, what you can say there, there's a possibility of having misclassification of expenses that need to have been included within the operating expense might be misclassified into cost of sales, leading to overstatement of cost of sales and understatement of the operating expenses. Is it clear, guys?
Yes.
Okay, fine. Then next it's about the receivables days. Consider like this. The prior year receivables days was 80 days and the current year receivables days is 120 days. We know that the receivables days symbolizes the number of days that an entity takes to recover its amount from the customer once the sales are being made. So as you can see over here, the receivables days has been increased significantly from 80 days to 120 days. So it symbolizes the possibility that there can be chances of having possibilities of bad and doubtful debts. And if there is any bad and doubtful debts, we know that it must be adequately be written off from the financial statements or provision should be created for such amounts. And there is always a risk that the company might not have written off the amount or they might not have included the amount of provision leading to overstatement of receivables and understatement of related expenses. So if the receivables days are increased, always consider the possibilities of having bad and doubtful debts in relation to the receivables. Okay. Then we will leave the payables days for the time being, and we will move to the area of inventory days. Suppose consider like this. It will be mentioned in your question that the inventory days in the prior year was 60 days. The inventory days in the prior year was 60 days. 60 days. And the current year receivables days is 110 days. Inventory days. So we know that the inventory is taking additional time period here to get sold. And in that situation, we can state that the inventories are being slow moving. Or there can also be chances that the inventories are obsolete. We know that if the inventory is slow moving or obsolete, it must be valued at the lower of cost or NRV. And what will be the risk there? There can be chances that the company might not have recognized it at lower of cost or NRV, leading to material misstatements in the financial statements. That's it. So this will happen if the inventory days are being increased from 60 days to 110 days or any such increase which is significant. Okay. So always keep it in mind, all the three main points, that the GP margin and the OP margin are moving in an inverse direction, opposite direction. In that case, we can say there's a possibility of having misclassification of expenses between the cost of sales and operating expenses. If the receivables days are increasing, we can state that possibility of having bad and doubtful debts for it. The amount should be written off or adequate amount of provision should be created for. And the possibility of risk will be the fact that they might not have done that, leading to understatement of related expenses and overstatement of the receivables. And if the inventory days are being increasing from 60 days to 110 days or any such increase is there, in that state, we can case that the inventories are slow moving or obsolete. Therefore, the inventory should be recognized at the lower of cost and NRV, and the risk will be the fact that they might not be valued at the lower amounts, leading to overstatement of both inventory and the amount of profit. Then there are many other ratios here, right? And the another ratio that we need to consider now is the interest cover ratio or the gearing. Consider like this: the prior year interest cover ratio was 1.9 times, and this year the interest cover ratio is 0.9 times. Or the gearing, last year the gearing was 50% and this year the gearing is 60%. We know that as the amount of gearing increases, the interest cover ratio will decrease. And in case if a company have taken some set of loans from some other companies or some other creditors, definitely there will be loan. That's why there is an amount of high gearing, right? So there will be certain covenants in relation to the company's loans and other debentures that have been issued by the company. And if these covenants are being breached, there can be a chance that the company need to pay off the whole amount of loan immediately back. Even if this is a business risk, it must be adequately disclosed in the financial statements. There can be chances that the company might not have disclosed that, leading to misstatements in the disclosures of the financial statements. So this is how we will be stating about the interest cover ratio. So just keep in mind, if the interest cover ratio is decreasing significantly or the gearing is increasing significantly, there's always a possibility that the covenants relating to the loan might have been breached, which may require disclosures in the financial statements. And the risk is that the company might not have provided adequate disclosures. Okay. All right. Then we need to calculate the other ratios as well. That's the payable days. Suppose the payable days are being increased from 50 days to 80 days. Current ratio, it was 1.9 times in the prior year. Current year, it is 1.1. Quick ratio, it was 1.6 in the previous year, 1.6 times. And this year is 0.8 times. So these are the stages of the ratios that we have calculated here. Then the next thing that you need to do is you need to consider all the ratios that are being in inverse situation, or all the ratios that are adverse in nature. So please mention, is it good to have an increase in GP margin and OP margin, or is it good to have a decrease in the amount of GP and OP margins? Which one is fair?
Increase.
Increase. What about the receivables days, payables days, and inventory days? Is it good to have an increase or decrease? Receivables days, payables days, and inventory days.
Decrease.
Yeah, it's good to have a decrease in the amounts, right? Because we'll be having more of the working capital. Then what about the current ratio and quick ratio and interest cover ratio? Is it good to have an increase or decrease? Current ratio, quick ratio. Is it good to have an increase in the amount of current ratios compared with the prior year, or is it good to have a decrease in the amount of current ratio? What will be better?
Increase.
Increase, right? So this is what we need to state here as well. See, we need to mention about all the adverse ratios that we have calculated. We will be mentioning like this. Since the gross profit is increased, it is not an adverse ratio. It is a very good thing to have an increase in the amount of GP. However, the OP has decreased. Receivables days, payables days, inventories, all other days have been increased and other ratios have been decreased. So we will to mention about the same thing within the answer as well. So we'll be mentioning in our answer like this. The company's operating profit margin has been decreased from 16% to 12%. In addition to which the receivables days, payables days, and the inventory days have been increased drastically. The current ratio, quick ratio, and interest cover ratio has been decreased significantly. All this shows chances of having uncertainties relating to going concern. And if there is any uncertainty relating to going concern, it must be adequately be disclosed in the financial statements. However, there can be chances that the company might not have mentioned about this in the financial statements, leading to material misstatements in the disclosures. Clear? So we will be comparing all the ratios together at a while, and we will be mentioning that about the possibilities of having uncertainties relating to going concern. And what should be the accounting treatment in that situation? All the uncertainties should be adequately be disclosed in the financial statements. And what will be the risk? There can be chances that the company might not have disclosed it properly within the financial statements, leading to material misstatements in the disclosure part. This is the basic evaluation of the analytical procedures on the basis of ratio computation. Is it clear, guys? Is it clear?
Yes, sir.
Okay, fine. So what will be the risk in relation to the increase and decrease or inverse relation in the GP and OP margin? Possibilities of having misclassification between
Classification of cost of sales
cost
and
of sales and
operating
operating
expenses.
expenses. Then what about the receivable days? Receivable days,
Bad and doubtful debt.
bad and doubtful debts. What about the inventory days? Slow moving or obsolete?
Obsolete.
Yeah. Then interest cover ratios decrease or gearing can increase. What will we call it as?
Covenants.
Covenants relating to the loan. Then all other ratios can be combined together, and we need to talk about the possibilities of having uncertainties relating to going concern.
Going concern.
Okay. Is it clear, guys? Properly?
Yes, sir.
Fine. Perfect. So, well, this is a very small part of the analytical procedure. Still, the analytical procedure is very wide and vast in scope. So, we will just do one thing. We will start with a question. We will go through a question and we will discuss the analytical procedures part in detail, because I don't think it's necessary to have a discussion, much further discussion on the audit risk part, because we were having already a discussion. Well, we had a lot of discussion about this in the regular classes, as well as I will also be providing you the notes for the audit risk part. So it won't be an issue for you, but sometimes this area might be a bit confusing. So we will practice a question from the area of analytical procedure. See, there's a question in your revision kit called Atoms Group. If you're using the very new revision kit, that's a revision kit of 2020-21 Kaplan revision kit, then this will be this will not be there in the initial questions phase. It will be as part of a specific exam question, which is there in the 599th page. Or you can also use your past question papers as well. This question is also there in the sample question paper, Atoms Group. So can you please take this question, Atoms Group question. So this is a question which is based on a combination of scenarios. Well, there is group-based scenarios here. In addition to that, there is analytical procedures in this question. So it is very good to have a question like this, because you will be able to practice all the theoretical areas together in a single question. So please take this question, Atoms Group. Atoms Group. So going through the question, what you can find over here is the details about the Atoms Group company. And you have got several set of requirements over here. The first requirement is to evaluate the audit risk to be considered in planning the audit of group, And it is clearly mentioned that your evaluation should utilize the analytical procedures for the identified relevant audit risk. So the examiner is requesting you to perform some set of analytical procedures here to find out the risk. Then the second question is based on the matters we considered before accepting the work of another firm. Next one is a question of the audit procedures, and the last one is a question of the ethical threats. Well, we won't be considering this part of the requirements for the time being because we are going to focus only on the audit risk part. Then you've got a very lengthy scenario with multiple exhibits, and they have given a group structure over here. They have mentioned something relating to the group structure. They've given a common scenario over here. And in addition to that, you have also received the consolidated financial statements of the entity, the total full-fledged consolidated financial statements of the entity, and plus some other scenarios as well. So this is a total structure of the question, which is a very lengthy question in your AAA exam. So what we are going to do now is to have a discussion on this question. So please do one thing. Please take this question and please go through it very quickly to have an overall insight about the question. And after that, we will start with the discussion part. Okay. And the only thing that you need to consider now is to calculate the ratios very quickly. If there is any possibility to calculate the ratios only, because in every situation, it won't be easy to calculate the ratios. If there is time limitation, it is not required to calculate the ratios. Other than that, we will be able to do some set of analytic procedures. I will mention you about that. Plus the thing that you need to do now is the fact that you have got a very lengthy scenario, right? So there will be some fact that will be included within the scenario that are directly connected to the company's financial statements. So if you think something that will directly appear in the financial statements in relation to the scenario given here, then you please cross-check the scenario with that of the provided financial statements so that you'll be able to find out the risk directly, or you will be able to trace the mistake directly from the question. Okay. So we will just do one thing. We will start with the question. So please start reading the question. Adams Group. Everyone, please go through the question. Please let me know once you've gone through the question. Okay. Done? Hello guys, have you gone through the question? Okay, fine. So let's look into the question. So we have got an introduction paragraph here. So it's 1st July 2015 and you are a manager. Just a moment. So let's go through it. So it's 1st July 2015 and you are a manager in D & Company, a firm of chartered certified accountants responsible for the audit of Athens Group, a listed entity for the year ended 31st May 2015. The group operates in the textile industry, buying cotton, silk, and other raw materials to manufacture a range of goods, including cloth, linen, and soap furnishing. The goods are sold under the Adams brand name, which was acquired by the group many years ago. Your firm was appointed as an auditor in Jan 2015. Is there any risk here, guys? Is there any risk?
New
Please contribute the
client,
risk that you have figured out. Okay.
Sir, deduction
risk?
risk,
Client.
no audit.
New
New
client.
audit client.
Yeah, it's a new audit client, right? Because you are being appointed to the audit on 1st Jan 2015, and the company's year end is 31st May 2015. So this is the current year in which you have been appointed as part of the company's audit. So definitely it's a current year audit, and you need to consider that fact. And there is always a possibility having two risks in relation to the new client. Which always the risk?
Opening balance.
Deduction risk.
There can be chances that the opening balances might be materially misstated. In addition to that, what's
lack
the
of
other?
listing requirements, knowledge of listing requirements.
Is it a newly listed client? No, it's not mentioned that it's a listed client, right? It's a newly listed, it's not mentioned there, right? So if it is mentioned that it is a newly listed client, maybe in the upcoming phase of the question, then we can state about the lack of knowledge about listing requirements. However, if it is a new audit client, what do we need to mention about that? There is a lack of knowledge about the client for the auditor. So there's a possibility of having a detection risk there. So the auditor might not be able to obtain sufficient appropriate audit evidence in relation to the client. Automatically, the detection risk will be higher in that case. Okay. So the first thing that you need to focus on while doing a 50 marks question is to note down the year end properly. Noting down the year end is very important because the year end the year end date will be used in order to understand whether it's a new client or not. First thing. Second thing, whenever in the further scenarios, if it is mentioned about any of the events that have been occurring, then you need to talk about the subsequent events. The subsequent events or the events after reporting period will only be able to be figured by considering the year end date. So if any of the transactions that have been done after the 31st May 2015, then it will be an events after reporting period. So you need to consider on the basis of this year end whether it's an event after reporting period or not. Then the third thing that you can find from the introductory paragraph is the knowledge whether it's a listed client or not, and whether it's a newly listed client or not. If it is a newly listed client, then you can talk about the risk that you have already mentioned before. That is the risk of having lack of knowledge about the listing requirements, as well as the possibilities of having management bias in that case. Okay. Then the next part of the question, I need you to begin the planning the audit of Adams Group for the year ended 31st May 2015. As you know, we have been appointed to audit the group financial statements, and we have also been appointed to audit the financial statements of the parent company and of all subsidiaries of the group except for a foreign subsidiary, L company, and the audit firm Clapton and Company will be auditing that particular company. All the components of the group have the same year end of 31st May, reported under IFRS standards and in the same currency. Okay. So what can you understand from here? They have mentioned that it's a very big group, as well as the group is also having one of the foreign subsidiary. So what will be the risk if there is a foreign subsidiary? What will be the risk in case if there is a foreign subsidiary?
Retranslation.
Retranslation risk will arise, right? Okay. Then you can talk about the IAS 21 about the retranslation risk. But will you get any marks in case if you have mentioned about the retranslation risk in this scenario?
No, sir, because
No.
like
Why?
it is in the same currency.
Exactly, because it's clearly mentioned that both the parent company and all of its subsidiaries are following the same IFRS standards, as well as the currency is also common in both the countries. So is it required to have any kind of retranslation in that case? Not required, right? Therefore, there is no such risk as well. Therefore, this must also be considered. You must not start writing the answers to the question before going through the total question. You must read the total question And only after that, you should start by writing the answers, because it will be mentioned that the company has a foreign subsidiary. And if it is mentioned that in the first paragraph, definitely you will go and write that particular risk over there as answer. And after going through the whole question, you will be able to find that sometimes the parent and the subsidiaries might be having same currency. And in that situation, the whole amount of answer that you have written will be useless, and you won't be able to score any marks for that. And in addition to which, you will also unnecessarily waste that time. So please ensure that you should write the answer only after going through the whole question. Okay, fine. Then let's go through the extract now. And the first thing, Rose Company, L Company, and B Company are all wholly owned subsidiaries. Acquired subsidiaries which manufacture textile. Adams Company also owns 25% of the Stewart Company, a company which is classified as an associate in the group statement of financial position, at a value of 12 million at 31st May 2015. The shares in Stewart Company were acquired in Jan 2015, and for consideration of 11.5 million. Other than this recent investment in Stewart Company, group structure remains unchanged for many years. So tell me, what are the risks that is being available here? So what is the actual fact in the question? The company have acquired a new subsidiary or an associate? Associate, right?
Associate.
Okay. So what should be the treatment for the associate? Well, we have discussed the risk earlier, right? So what will be the accounting treatment that are being required for the treatment of an associate?
Equity method.
Equity method. And in the equity method, how do we need to account that?
At cost.
At cost. Okay. At cost, we must recognize the amount in the SOFP, right? So let's do one thing. This is what I mentioned. If there is something in the scenario, and if there is a connection between that scenario as well as the statement of financial statements, financial position and P&L, you must cross-check it with them. So they have shown the investment in associate here. They have made an investment of 11.5 million, but now it is being reflected as 12 million. And what will be the reason for that? Maybe due to the inclusion of the amount of profit from the associate, right? So it is being accounted there properly. So is there any additional requirements to mention something within the SOFP? Do we need to mention anything in the SOFP in relation to the associates balances? Nothing? What else, guys, we need to show within the SOFP? Nothing in the SOFP. Then what will be there in the SOPL?
Investment in associate.
Share of income, right? As a single line item. And please look at here. Is there any disclosures over here? No, there are no single line items here, right? So which means that the company have not included its share of revenue as a single line item here. It might be either be misstated, or it might be omitted, or it might be combined with some other expenses or income that might have happened, and it have led to improper classification of item within the financial statements. Therefore, the financial statements are materially misstated. That's issue here. Is it clear?
Yes.
Yeah. And in addition to that, you can mention about the other risk as well, which means that you can mention about the risk in relation to the accounting methods. You can consider about talking about the impairment. You can talk about the disclosure of the income. Then you can also talk about the classification that even though the company have got more than 25% of the shareholding, they might not have still received the amount of control within the associate. Maybe they might not be able to significantly influence associate. And in that situation also, they cannot show them as an associate. You can also mention about that as well. Okay. So these are the common risks that you can include in relation to the acquisition of an associate in this question. Yeah, let's move on to the other part. Adams Company is a parent company in the group, and its main activities relates to holding the investment in the subsidiaries and also the brand name which was purchased many years ago. Adams Company imposes an annual management charge of 800,000 on each of its subsidiaries, with the charges for each financial year payable in subsequent August. Our company manufactures luxury silk clothing, with almost all of its output sold through approximately 200 department stores. Rose Company's draft statement of financial position recognizes assets of 21.5 million at 31st May 2015. Any silk clothing which has been sold within 12 months is transferred to L company, where the silk material is recycled in its manufacturing process. So what are the risks here? What are the risks here? So any risk over here?
There's a related party transaction, so management charges should be eliminated from consolidated financial statement, but in individual financial statement, it should be disclosed.
And what will be the risk there?
Non-disclosure in individual financial statement and disclosure in consolidated financial statements.
Exactly. That's a point. So you need to mention like this. While consolidating the company's financial statements, all the intra-group transactions should be eliminated. However, there is an annual management charge of 800,000 from each of its subsidiary, and the company is having 3 subsidiaries, right? So in total, 2.4 million is the total figure. So the 2.4 million might have been included within the company's financial statements, and the amount of receivables and the payables will be overstated. And in the individual financial statements, the amount of intra-group transaction should be treated as part of an related party transaction as per IAS 24, which needs to have additional amount of disclosures in relation to the intra-group transaction. And over there, the risk is that this might not have been provided, leading to material misstatements in the disclosures of the financial statements. So that will be the risk in that situation. So this is what we need to state in relation to the management charges. So is there any other risk over here in the second paragraph? Any other risk?
Inventory in different locations, inventory in multiple locations.
Exactly. The company is having 200 department stores, right? If a company has got 200 department stores, definitely it might be having many of the inventory warehouses. And what will happen if there are multiple inventory warehouses? What will happen if there are multiple inventory warehouses?
The auditor cannot
Deduction
attend
risks are auditors unable to attend all the inventory.
checks.
Exactly. There is a possibility of having detection risk that the auditor won't be able to appear for the inventory count at all the warehouses at the same time. Therefore, the auditor will not be able to obtain sufficient and appropriate audit evidence in relation to the inventory, leading to detection risk in the audit. And in addition to that, you can also talk about the fact that since a company are having many of its warehouses, they might not have maintained robust amount of internal controls in all of these warehouses. In that situation, the count might not be appearing correct. There is a possibility that the inventory may be either understated or overstated. Therefore, the financial statements will be materially misstated. You can also talk about the control risk as well. So these are the risks I have included here in relation to the inventory which have been held under multiple locations. And I have given it as a straightforward point that if the inventory are located at multiple locations, there is always a possibility of having 2 risks. But here they haven't mentioned that the inventory is held at multiple locations, instead of which they have shown us that the company is having more than 200 department stores. Therefore, we need to assume that might be having multiple inventory warehouses. Okay. All right. And one more thing, guys. And we have mentioned here both about a control risk and about the detection risk in relation to the multiple warehouses. And you should write that only if you're getting a question on the audit risk in the same manner you get it in this question. Or if you're getting a question on the risk of material misstatements, keep that one in mind. The risk of material misstatement will not consider the possibility of having detection risk, and that should be avoided. Clear? Is it clear, guys?
Yes, sir.
All right. So what's the other risk that arises here? Is there any other risk over here? Is there any other risk over that case? There is a transfer of some goods from one company to another company. From which company to which company? Rose company is transferring the goods to the L company. So what will happen if there is a transfer of goods? It's another possibility of having an intra-group transaction, right? And since it's a sale of a good, there is a possibility of having unrealized profit as well. And we have studied it in the standards that if there is any possibilities of having unrealized profit, then the company should have recognized a provision for unrealized profit, and this amount should be reduced from the amount of profit as well as from the amount of inventory value. Or else what will happen? The amount of inventory as well as the profit will be overstated, leading to material misstatements in the financial statements. In addition to which, we also know that if there are any intra-group sale, then it must be treated as a related party transaction within the individual financial statements and must be adequately disclosed for. Again, there's a risk that it might not have been adequately disclosed in the financial statements, leading to material misstatements. Clear, guys? Okay. Then next paragraph. L company is located in Farland, where it can benefit from low-cost labor in its factories. It produces low-priced fashion clothing for the mass market. A new inventory system was introduced in March 2015 in order to introduce stronger controls over the movement of inventory between the factory and stores. L company is audited by Clapton and Company, and its auditors report in all previous years have been unmodified. Clapton and Company is a small accounting firm, but is a member of international network of firms. L Company's draft statement of financial position recognizes assets of 24 million at 31st May 2015. Yeah, tell me, what will be the risk here? What will be the risk here? Is there any possibility of having a risk on this paragraph?
No, because it's a different auditor. Clapton is a different auditor.
Clapton is a different audit firm. Okay, so will there be any possibility of having risk?
Yeah, they have risk.
They might be having risk, but there's one thing. Clapton is auditing one of its subsidiary, means one of our subsidiary, and we are responsible for the audit of the consolidated financial statement. So Clapton's work will also affect our work, because if the Clapton is not properly doing the audit, there will be undetected mistakes in the financial statements of the subsidiary entity, and that mistakes will also be recurring in the consolidated area, because we are going to consolidate the subsidiaries accounts together, so there will be risk. Okay, so what will be the risk in that case?
New IT system, inventory system.
No.
has
In
been-
relation to the Clapton company, what will be the risk? Any risk?
So,
Just
sir,
sorry.
we are not directly involved in the audit of that subsidiary, so detection risk will be high for us.
Exactly. That's a point. So always keep that in mind. If you are using any other auditor's work during the course of your audit, or if you're using any other audit expert's work during the course of your audit, if you're using any work of the internal auditor of the entity in which you are performing the audit, in all this situation, if the work of the persons of whom you're using is not having an adequate amount of experience or knowledge, then the possibilities of having mistakes will be very high. And it may lead to detection risk in the financial statements audit. Okay, so keep that one in mind. Whenever the question mentioned about the usage of an internal auditor's experts, or an external auditor, another external auditor, that's a component auditor's work, always there is a possibility of having a detection risk if they're not having adequate amount of knowledge. Okay, so you can talk about that over there. Then what was the other risk in relation to the new inventory system? Someone was talking about the risk. What was that?
So when you change into a new system, the transfer of old data to the new data there could be errors in that, and also the new system may not operate efficiently, like the way the management thinks. So
All right, perfect. So that's the risk here. Since the company has introduced a new inventory system, we know that there's a transfer that is required to transfer the whole amount of data from the old system to the new system. And if the old data is being transferred to the new system without taking adequate amount of controls, then the inventory will be either understated, or there can also be chances that the inventory will be overstated, leading to material mistakes in the financial statements. That's a risk that you need to mention over there. Okay, and let's move on to the next main paragraph. B companies manufactures soft furnishings, which it sells through an extensive network of retailers. The company is cash rich, and the surplus cash is invested in a large portfolio of investment properties, which generates rental income. The group's accounting policy is to measure the investment properties at fair value. B company's draft statement of financial position recognized the asset of 28 million at 31st May 2015, of which investment properties represents 10 million. So what does it mean? The company has invested some of the surplus amount of its funds within the investment properties. And in case if the company has invested in investment property, how do you need to account the investment properties as per IAS 40? How do you need to account that?
At fair value.
either cost
Either
or
through
fair value.
cost method or through
Fair value.
Fair value method. Okay, fine. And if we are recognizing it at a fair value, then the fair value gain and loss should be included, right? So do we need to include it within the OCI or within the SOPL?
SOPL.
SOPL.
Yes,
Profit or
we
loss.
know that we need to include that amount within the SOPL, right? And what will be the risk there? Let's do one thing. We have got the full set of financials here. We can just do one thing. We will just go and look at the investment properties value. Yeah, it's understood that they have recognized it at fair value. And the prior year value was 7.5 million. Current year value is 10 million. So what's the difference, or what's the amount of increase in fair value? It's 2.5 million, right? Because the prior year it was 7.5 and the current year it's 10,000. Sriman, can you please mute your mic, because there's a lot of noise coming from me. Okay. So the prior year it was 7.5 million and the current year it is 10 million. So the amount of increase is 2.5 million. And we know that this 2.5 million should be included over here. And is that included properly? Have we gone through the scenario? Is that one included here properly?
No.
Yes.
No. Where is it? It's over here within the OCI.
OCA.
They have included the gain on investment property is 1 million, and the prior year it was mentioned as 3 million a year. And is it a proper accounting treatment? No. We need to include the fair value gain within the profit. The fair value gain should be included within the profit. That too, the fair value gain of the current year is 2.5 million, and they have included only 1 million. So we can state that either this remaining 1.5 million might be omitted from the financials, or there can also be chances that it might be netted against some other expenditure, or might be included as part of some other income, leading to misclassification in the financial statements. Is it clear? And you know, a figure over here, it's 2.5 million is the amount of mistake. So you need to calculate the materiality for the 2.5 million as well. Is it clear, guys? Okay. And all the cases where you have received figures, and all these situations also you can calculate the material. Say, for example, here we have talked about the company's management charges, which is 8.8 million into 3 times, that accounts to 2.4 million. So here also you can calculate the materiality for the 2.4 million. We'll receive marks for that. So always keep that one in mind. Do not forget to calculate the amount of materiality, because it's a very easily scorable mark. Please don't miss that. Okay. So we will continue with the scenario itself. During the year, the group attracted negative publicity when an investigation by a well-known journalist alleged that child labor was being used by several suppliers of raw materials to L company. The group refuted the allegations, claiming that the supplier in the question had no contact to supply L company, and the group always used raw materials from ethically responsible suppliers. The media coverage of the issue has now ended. The group finance director is confident that negative publicity has not affected the sales of the group, saying that in fact the sales are buoyant, as indicated by the increase in group revenue this year. The group has a policy of non-amortization of Adam's brand name. The brand name was acquired by the group many years ago and is recognized at its original cost. The previous audit firm accepted the policy due to the strength of the brand name and the fact that the group spends a significant amount each year on the product development and the marketing aimed at supporting the brand. The group has maintained a good market share in the last few years, and the management is confident that this will continue to be the case. So what is the issue here? So what's the issue here?
Non-amortization of brand.
Non-amortization of brand. So what will be the risk in relation to non-amortization of brand?
Overstatement of intangible assets and understatement of expenses.
Exactly. So how does that risk arises here? We know that as per IAS 38 intangible asset, every asset that has a finite useful life should be amortized over its useful life. And here the company is stating that they are spending significant amount for the advertisement and as such, and they are stating that therefore they haven't charged any of the amortization. But this is not a valid claim, right? If the assumptions used by the management are not reasonable, then the amount of profit will be overstated and the amount of amortization will be also amount of intangible assets will also be overstated. So that's a risk over there. Any other issues, guys? Any other issue? What are the other issues? Nitin, what is issue? Yeah, exactly. Impairment. You can talk about the impairment because there is an issue with regarding the group's brand name. Well, it is not directly affecting the group. It is something that affects a group supplier, and the group is claiming that the company's sales are still going. But we know that this negative publicity have affected the group's brand a lot, and the company should consider the possibilities of impairment, right? Because there's an external indicator of impairment here. So since if there is an external indicator for the impairment, we should have recognized impairment as per IAS 36. And what is the risk here? There can be chances that the company might not have recognized the impairment expenses, leading to understatement of impairment and overstatement of the related expenses. Clear, guys? Okay. Then, as part of the company's management strategy to increase the market share, bonus scheme has been put in place across the group, under which the senior managers will receive a bonus based on increase in revenue. The group's accounting and management information systems are out of date, and the group would like to develop and implement new system next year. The audit committee would like to obtain advice from D&D company on new systems, as they have little specialized knowledge in this area. Tell me, what are the risks?
Management might be motivated to overstate the revenue in order to achieve the bonus.
Exactly, because the bonus is based on company's increase in revenue. So we can state that since the bonus are based on the amount of increase in revenue, there can be chances that the management might be motivated to overstate the amount of revenue to receive a more amount of bonus payments. Therefore, the financial statements misstatement will be very high due to the management bias. That's a risk. Perfect. Then what else?
When the new system is implemented, the company won't have enough skills and experience to.
No, they haven't introduced the new system. They are planning for a new system. Currently, their system is out of date.
Control deficiency.
Exactly, that's the point. The company's accounting and management information system are out of date. So there's a possibility that there is a control failure for the company, and the control risk will be very high. The possibilities of having mistakes in the financial statements due to the out of date management and accounting system will be very severe. Therefore, the possibilities of having mistakes in the financial statements will be increased to another extent. Clear? Okay. So these are the risks in relation to these areas. And finally, it's something relating to the financing as well. Well, the financing part is not directly connected with that of the audit risk question, but still we will be able to collect some points in relation to the audit risk. So we'll just go through that very quickly. In addition, the audit committee requests that the group audit managed partner attend a meeting with the group's bank, which is planned to be held the week after the audit report is being issued. The purpose of the meeting is for the group to renegotiate its existing lending facility and to extend its loan, and will be attended by the group's finance director, a representative of the audit committee, as well as bank management. The group is hoping that the audit partner will be able to confirm the group's strong financial position at the meeting, and also confirm the audit included procedures on the going concern. Specifically, the audit of the group cash flow forecast for the next year will be, which the bank requests as part of lending decision. This is all that is stated over here. So what is the total summary from this part? That the company is going to have a new bank loan, and they are going to renegotiate the loan with the bank. So what will be the risk when a company is planning for a renegotiation of a loan? What will be the risk?
It will be like the companies in standing in support for the client. It's against the professional duty of
we don't want to consider anything relating to the threat. Advocacy threat or any other threat can be avoided here. Well, there is a possibility of having advocacy threat. Very good for that. However, I'm asking you about the audit risk. What will be the audit risk here? In relation to
insufficient cash balance, covenant breach.
Well, it is not required to talk about the gearing here, because the company haven't taken the loan. They're planning for the new loan.
Auditor might not perform the correct procedures which can demean the cash flow, or which might show the cash flow forecast as not like might show the different, so that like, the cash flow should not be look bad, right? So that he can negotiate with the bank to get the loan.
Well,
He might
that
not be
really
independent.
okay, fine. I understood the point, but that really counts as part of the ethics. Okay. So here we need to consider about the mistakes that will be made by the management with regarding this.
Sir, management may cook the books so that it will help them to get the loan. Maybe cash balance.
Exactly. The thing is that, see, I've already mentioned you a point over here. See, when there is the risk in relation to a new listed client, we have mentioned that the management will be biased to overstate the amount of profit as well as the amount of other assets in order to attract the investors. And the same case is also applicable when the company is making a new share issue. Then when the company is applying for a new loan with the bank, and all those cases, or if the company is issuing a new debenture, in all these cases, the meaning is very similar, that the management will be biased to overstate the amount of profit and the assets. In case of a newly listed client, it was for the purpose of attracting the investors. And in this case, it will be for the purpose of attracting the bank for giving them a better credit option. Is it clear? Okay. So that will be the risk in relation to renegotiation of a bank loan. So always keep this one in mind. If it is mentioned in any part of the question that the company is planning for a new loan, then you can always talk about the management bias, possibilities of having management bias. All right. Well, now we are going to move on to the most crucial part of this question. Well, we have actually taken this question to purely discuss about the analytical procedures part, and we haven't yet started with it. And for the time being, I'm not talking about the analytical procedures in relation to the ratios, because you might not have calculated that. And we have already discussed the ratio related points. So we are not mentioning about that. We will be using all other kind of analytical procedures by the means of comparison to find out the risk. So once after going through the scenario, the next thing that you need to have is to look at the items from the SOFP first. So we need to go through each of the item and you need to check whether there is something unusual here. Yeah, the first one is with the property, plant and equipment. The property, plant and equipment, the current year value is 45,000. Prior year was also 45,000. Will there be any risk in that case? The balance is zero. The difference is zero. Will there be any risk in that case?
Depreciation of charge.
Exactly. Well, we know that every company will be having a set of depreciation expenses. So basically, if it is a land, then there won't be any depreciation, but it includes the company's property, plant and equipment. And they are stating that they have got same value over the both years. So there is always a possibility that the depreciation might not have been included by the company, leading to overstatement of the property, plant and equipment and understatement of the related depreciation expenses. Is it clear?
Yes.
Okay. Then we have already discussed about the investment property here. Then the brand name, we have also discussed about the brand name as part of the impairment and amortization. We have also had a discussion on investment in associate. Then, so we have already covered all the things that I have included over here. Is there anything that you missed here when it comes to consolidated financial statements? Is there something that you usually used to find over here?
Sir. Goodwill.
Exactly, goodwill. There is something always called goodwill, but it's missing here, right? So what will be the risk here? Basically, if a company that has more than 3 subsidiaries and an associate is not having goodwill, so what will be the reason for that? Either they might not have recognized the goodwill properly in the financial statements, or there can also be chances that the goodwill might already be fully impaired. And in the case that the goodwill are not accurately calculated and included, then in that case, it may lead to understatement of the intangible asset and understatement of the intangible assets. Clear? Is it clear, guys?
Yes, sir.
Okay, fine. Then the amount of inventory remains the same. Sorry, the amount of inventory has increased, receivables has increased, and cash has increased. Well, we are not going to discuss about 3 of this now, because the inventory, cash, receivables, and payables will be included within your ratio calculations. Okay, inventory days, receivables days, and payables days will cover all this part. Next is about the share capital. See, in this question, the share capital remains the same, so there's no issues. However, consider like this: if there is an increase in the amount of share issue, then you can always mention about a risk there. Two risks. There will be two risks in relation to that. If a company has issued share capital, we know that the share capital amount should contain only the nominal value of the share issue. And the whole amount of share premium should have been included within which account?
Share premium.
Share premium account. What will be the risk there? There can be chances that the company might not have classified the share capital between the share capital account and the share premium, leading to overstatement of share premium, share capital and understatement of share premium account. You can state like that, misclassification. In addition to that, we know whenever a company makes a share issue, the whole amount of share issue and its related disclosure should be provided within the notes to financial statements. There is also a risk that the company might not have provided disclosures in the notes to financial statements, leading to leading to material misstatements in the disclosures of the financial statements. So two risks can be included in relation to the share issue. The next one is regarding the retained earnings. So what's the difference in the retained earnings here? The most crucial point, this point will always be there in the scenario. And if this point is there, definitely it's very simple to score marks from this area as well. So the retained earnings of the company has increased here. It was 24,600 in the prior year and 34,000 in the current year, which means the current year profit has been included. So what's the difference here?
9,400.
9,400 is a difference here. Perfect. Then, what is the amount of current year profit? Current year profit. What's the amount of profit? It's 9,700, right? So 9,700 is the amount of profit, out of which 9,400 only appears in the retained earnings. We know that a company's profit will only be split into two parts. The one part will be retained earnings. So out of 9,400, 9,700, 9,400, it's still there in the retained earnings. And the another outflow of profit will be in the form of the dividend, right? So there is a possibility that company have issued a dividend of 300 this year. And we know that if the dividend are distributed or if the dividend are announced as such, then it should be adequately be disclosed within the financial statements. There is a possibility that the company might not have provided adequate amount of disclosures in the financial statements, leading to material misstatements in the disclosures of the financial statements. So that will be the risk here. Is it clear? Okay. So please keep that one in mind. If the difference appears within the current year profit and the retained earnings, and if the retained earnings balance is lesser than the amount of profit, then we can always state that there is a possibility of having issue or distribution of dividend by the company. And if the dividend are distributed, it must be adequately disclosed in the financial statements, or else the financial statements will be materially misstated as the disclosure part. Is it clear? Okay. Next, it's about the bank loan. The company's bank loan remains same in the current year and the prior year. So it's another important point. See, you need to first check the movement of the bank loan between the current year and prior year. And you should match it with the company's statement of profit or loss. So you need to check the amount of finance cost. The finance cost remains the same. So there is no risk here in this question because the amount of loan remains the same. Finance cost also remains the same. No issues with that. But if there is an increase in the amount of bank loan, then you must cross-check it here and you must ensure that that same increase is also made in the finance cost. If not, that's a risk. You need to check whether there is any decrease in the amount of bank loan as compared with the prior year. And if there is any decrease, then you must ensure that that same decrease is also shown in the net finance cost, or else the finance cost will be overstated. If the bank loan remains static over the past 2 years, if it is constant, that there is no movement in the bank loan, then you must cross-check it with the finance cost and ensure that there are more movement in the finance cost. And if there is any movement, then the finance costs are materially misstated. So this is how you need to cross-check the bank loan with that of the finance cost. Is it clear? Okay. And trade payables are already covered. And you can also talk about the tax expense. So what you can talk about the tax expense? If the tax expense is included here, then you can talk about that. Say, for example, if you need, you can calculate the effective tax rate, which means a tax divided by profit before tax of the current year and prior year can be calculated. Basically, we know that almost the tax percentages will be same if they are within same tax slab. And if there are significant difference in the tax rates, which means the tax percentage is calculated, you can quote that there is a possibility that the tax rates used for computation by the company might be misstated. And also you can check one more thing. Sometimes in many of the questions, it's seen that the tax expense will remain the same. We know that the tax expense will be changed in respect of changes in the amount of profit. So that is also not shown here. So you can talk about that as well. In addition to this, if you need, you can talk about additional points as well. See, they have included the amount of OCI here. The amount of investment properties gain is included within the OCI, both in the current year and the prior year. But surplus account is not shown here. Revaluation surplus account is not shown within the equity. And consider like this. Here, all the companies, all the subsidiary companies are fully owned by the parent company. So there is no problem. However, on the other hand, if it is mentioned in the question that we are not having full ownership over the company's assets, if it is not a fully owned asset company, then the amount of NCI should be shown here. And if the NCI is not shown, you can also mention about that as well. For this question, it is not relevant because all the companies are fully owned by the parent company. So there is no issue to include the NCS. There is no requirement to include the NCS point here. But in other questions, you can consider that possibility as well. So this is how you will be doing your analytical procedures part. First of all, you will be starting with the statement of financial position. You will be going through each elements of the statement of financial position, and you will be interpreting the results as such by comparing with the prior year and calculating ratios. And you need to match the scenarios with that of the financial statements as well. And in addition to which, you can also calculate the GP margin and OP margin from this area to understand whether there is any inverse relationship between the GP margin and OP margin. Okay, so GP margin and OP margin should be calculated. And you can also calculate the amount of increase in the revenue as well as corresponding increase in the amount of cost of sales. You can calculate that percentage of increase in revenue and percentage of increase in cost of sales. And you can check that whether these both changes are moving in a constant manner or there is proportionate movement in the amount of cost of sales as there is increase in the amount of revenue. If that proportionate increase is not there, then what we can talk about that, there is a possibility that the revenue might be overstated or the amount of cost of sales might be understated. Here you can properly talk about the revenues overstatement because company have already mentioned that they're providing the company's bonus on the basis of the increase in revenue. So you can also talk about that risk as well. So these are the risks in relation to the question. So these are the risks that you need to figure out from your question, Athens group, in relation to analytical procedures as well as in relation to the audit risk. And if it was a question on risk of material misstatements and analytical procedure, the only change will be in the fact that you need not include any points in relation to the detection risk. Everything else will remain the same. So this is all you need to consider in relation to the audit risk question. So always keep these points in mind while presenting the answers. In all possible cases, you need to calculate the materiality. You need to mention about the accounting treatment. You need to mention about what will go wrong or what went wrong. And you need to mention about the impact in financial statements. And if it is a general case, such as the bonus payments, then amount of the bank loan that are going to be taken by the company. If it is general risk like that, then just identify the risk, explain the risk, and give the impact, overall impact over the financial statements that you need to do over there. Plus, while calculating the materiality, you need to consider the materiality on the basis of P&L element or on the basis of balance sheet element. In addition to that, you must also consider whether an item is material on the basis of its nature. While reading the question, please note down the year and date to understand whether there is any possibilities of having subsequent events or whether it's a new client. And you must also trace from the beginning part of the question about whether it's a new client or a newly listed entity as well. So these are the points that you need to consider while doing a question on audit risk. Is it clear, guys?
Yes, sir.
All right. So to download the materials in relation to AAA or in relation to any other papers, you can log on to Eximus Learning Media. Okay, the Eximus Learning Media website. And over here, you have got an option to download the files. And please scroll down and you can find the notes for advanced audit and assurance. and all the notes are included within the drive. So you can download it anytime as your requirement. So this is all you need to do in relation to this audit risk part. Okay. So that's it, guys. So please do one thing. Please revise the area of audit risk. Please download the notes in relation to audit risk. Please go through all the notes in relation to audit risk. And this is the most crucial part of the paper AAA, because we have already covered a particular area with a weightage of approximately 18 to 23 marks, which is mostly around 40% of your pass mark that you need to cover. So if you have got a good grip about the audit risk part, definitely the 25 marks area will also be much simple for you, because the same reporting format or the answering format will be used in the 25 marks area also, especially in the reporting questions. So if you have got an in-depth knowledge in the audit risk part, it will definitely be very helpful for you to have a good insight about the 25 marks area. The only difference is that the audit risk part area will contain both the general risk as well as the risk in relation to the accounting treatment. When it comes to the 25 marks area, there the risk will only be based on, or the mistakes will only based on accounting cases. There won't be any other general cases. And one more thing, I can assure you one thing, that the kind of questions that are going to ask you during the course of your exam will remain the same as what we discussed in the class. And the only change will be with the scenario. And when it comes to the scenario will have general cases that remains the same. The only difference will be there in the scenario is of the accounting treatment. So to cope up with the differences and to cope up with the changes in the accounting based scenario, please try to have good understanding about the standards of SBR. So please revise all the standards of SBR. And if there is someone who haven't done that, please do one thing. You can take the AAA Kaplan textbook. If you move to the back side of the textbook, there's a chapter called Financial Reporting Revision. Please go through that chapter. Well, that's a very small chapter which contains only around 17 pages. And you know that the Kaplan textbook, the content is very small with increased very large font size. So you can just go through that. They have included some set of standards that are required for your AAA paper. They haven't included excessive amount of standards that like how you study in your SBR paper. They have included adequate amount of details in relation to standards. So please go through that to have a better understanding. Okay. So this is all you need to do in relation to the 50 marks area. That is the audit risk part. So we will continue with the session tomorrow. We will be practicing other areas of the question tomorrow. That is the additional information part. Then the audit evidence part. Then in addition to that, the ethics part, as well as we will also discuss some part of the 25 marks area also tomorrow. And day after tomorrow, we will be focusing purely on the 25 marks area. And we will be going through some more set of the questions of the 25 marks area. So this is how we are planning for the session. Is it clear? Is it clear, guys?
Yes, sir.
Yes,
All
sir.
right. All right. So that's it. So we will continue our session tomorrow. So please go through the session and please have a good insight about the session that we have already covered today. Okay. All right. And this class's recording will be available in YouTube. So if you want to watch it anytime, you can go and access the YouTube, and it will be in the channel Biju Palak in my own channel. So if you want, you can watch it anytime, and also you can share it to your friends as well. And you can share the notes also with your friends in case if any one of them want. Please ensure that you complete the notes by today or tomorrow morning itself, because we'll be having discussion about the notes in tomorrow also. So to have a good discussion, definitely you need to have an understanding over that. So please go through the textbook as well. Okay. All right. So that's it, guys. Thank you so much. Bye. See you.
Thank you.
Bye-bye.
Thank you, sir.